Good afternoon, everyone. As Yvonne mentioned, there has been an ongoing debate surrounding the use of removal versus reduction credits. Reduction remains one of the most cost-effective approaches to near-term direct climate impact at scale, and yet it faces increased scrutiny on overcrediting concerns. At the same time, the perception that removals is better or more credible than reductions is further amplified by certain industry-level guidelines or certain corporate directives permitting only the use of removals. Yet, the Integrity Council for Voluntary Carbon Markets, the ICVCM, has approved several reduction methodologies, including REDD+, household devices, which all imply that they are perfectly compliant with the core carbon principles. Now, even within removals, there are engineered technology versus nature. At the same time, that also creates different perceptions of durability and permanence. So our panelists today actually precisely cover this spectrum of activities, and I'm hoping that they will help us to unpack the role of removals and reductions. Now I'm going to kick off with you, Will, the Nature Conservancy. As I understand it, the conservation hierarchy suggests or even emphasizes the following order of priority. You first protect, then you manage before you restore the lands. Does it therefore frustrate you, Will, that conservation or reduction projects are sometimes deemed as inferior or poorer quality than removals? And perhaps you can share with us some successful examples of conservation projects and the tangible impact they can deliver.
No, thanks Ling Min, and thanks to GenZero for hosting the event today. It's wonderful to be here, and it's great to see an enthusiastic crowd. I think that's what it was described as previously in the past session, which is great, and just great to see the energy and discussion here, which is good. Yeah, from our point of view as the Nature Conservancy, it is frustrating. I think it's fair to say. A huge amount of the world's natural systems have been lost, destroyed, or degraded, but there's also vast areas of grasslands, forests, wetlands, and other natural ecosystems that still exist, and that's wonderful. They still exist, and they're still there to be protected and conserved and sustainably managed if we can get it right. The challenges at the moment and the historical trend is we haven't got it right. That's what the data would suggest. And so from our point of view, it's critical that we do find ways to really protect what's there. And I don't mean necessarily like protected areas, national parks. They are very important, have a critical role to play, but also the sustainable management of natural systems to get that right. Restoration, on the other hand, is also very important. There's no doubt about it. We've lost a huge amount across the world, and if this provides an opportunity for us to restore those natural systems in a credible way, while also helping to tackle climate change, that's great. That will generate opportunities. But we can't get away from the fact that the existing intact natural systems are way more biodiverse and generally hold way more carbon. And if we're not prepared to find a way to sort of solve that and protect those areas, that's a huge loss. So just very briefly, as guys, I guess two examples that I'd point to, or a few different examples I'd point to. On the reduction side or the avoidance side, the natural forests of Indonesia are vast areas of incredibly beautiful and important rainforests. The Nature Conservancy and our partners are proud to be working there. We have for decades. There is a desire and a willingness from corporations, from communities, and from NGOs to find a way to protect these forests. They don't want to. They need a way to do that still enables economic development to happen, and that's what we're focused on. Is there a way to sustainably harvest timber from these forests, which we believe there is, and we've developed carbon methodologies that enable that, while preserving and protecting the integrity of the natural forest, so it still can provide a habitat, but it also store vast areas of carbon. So that's one example of a conservation project that we've been working on for a long time. And it's great to see the enthusiasm starting to build in that sector, but it has to come down to an economically viable pathway forward for that type of thing to happen. If there's no economically viable pathway, it's very hard to see how we'll move away from business as usual. Another quick example more on the restoration side, where it's really important down in New Zealand, which is also within our remit at the Nature Conservancy, they've already cleared large areas of forest and have real problems with erosion on the sort of hillsides and whatever else. And that's a great example where restoration has a really critical role to play. But it's got to be done well with the right species. It's got to be done in a way that doesn't sort of just lead to monocultures and other sort of perverse outcomes. And we believe there's opportunities to do that. But so yes, there are lots of good examples of high integrity projects that get that carbon and biodiversity benefit. And I think we need to sort of get over this debate of sort of removals versus reduction, and as I think the previous panel said, get on with both. Yeah.
Thanks so much, Will, for that. I love the tangible examples that really bring to light some of these concepts, and particularly your comment around the focus on economic development beyond just sort of carbon project designing aspect. That's great. Ben, you co-authored the Oxford Principles for Carbon Offsetting. And while it acknowledges that reduction still plays an important role in at least the next decade or so on the pathway towards net zero, it's definitely underscoring the critical need to transition urgently towards removals with durable storage. Now, maybe help us understand how we should think about reductions and removals over different timescales. And actually, the way that the distinction has been set up in the Oxford Principles, do you think that it unfairly biased action towards removals, and in fact is shifting the narrative away from reductions?
Yeah, well, thank you for that introduction. And yes, I am one of the many co-authors of the Oxford Offsetting Principles, though I do have the distinction of being the guy that came up with the idea down the pub 6 or so years ago. But in terms of you know, the framing and is it unfair that it's, you know, yes, it is trying to, the very nature of it is trying to open up a conversation about the importance of removals. And I think that is a conversation we obviously need to have and weren't having and are starting to have a bit more, and I think the principles have helped with that. That clearly does not detract from the need to do emission reductions. That's not what we're saying. We're saying we need a plan to scale up the carbon removal budget as quickly as possible, as well as make sure that we exhaust every single emission reduction opportunity that exists out there. And so it sort of worries me that we have this framing that it's a zero-sum game. And I understand, you know, there is deep anxiety in the carbon markets, in the voluntary carbon markets now. I get that the price is not where many people would like it to be. I get that demand is not where people hoped it would be or where it should be. And I think that that is driving this sort of zero-sum game dynamic. Clearly, in terms of global net zero, it is not a zero-sum game. It could be a zero-sum game in a small carbon market, and I think that is basically the problem. You know, the carbon market is not of the scale that we need it to be, that the big failure is not a conversation about removals. The big failure is that policymakers are messing it up and are not doing what they ought to be doing. And so I think we need to kind of hone in on that conversation. And I think when we're thinking about, you know, this unfortunate state of affairs that we're in at the moment, and by the way, I don't want to kind of make it sound too negative, there's lots of positive action and work going on, is that, you know, the market is smaller than it ought to be. The way in which we scale that market is actually by focusing on integrity and quality, because that's going to inspire the trust that's needed for policymakers and others to use the carbon markets as an instrument to achieve policy objectives. And of course, it's only one of many possible instruments to do that. So a bit of a defense of the principles, a bit of a defense about talking about why we're talking about removals, and let's collectively focus on the real source of the problem, which is not talking about removals, it's the policy failure.
Yeah, thanks for that, Ben. And later on, we will indeed dig a little bit deeper around what drives integrity and quality, especially from a ratings perspective. Hold that thought. Just on removals, right, Christoph, you are focusing solely on removals. And actually, probably Climeworks is best known, at least to me, for its direct air capture DAC technology, although you've also now moved into even nature-based solutions like afforestation, biochar. What triggered the shift? And again, how should we be thinking about technology-based removals versus nature-based removals?
Well, thank you. Before answering the question, let me share one observation. I've been in climate for the last 18 years and visited a lot of conferences and summits. And this is the first time I'd like to express a big thank you and convening power to GenZero. It's the first time I'm at a climate summit where people have a hard time to find a place to sit. So I think that's remarkable, and I wanted to share that. The second thing before answering your question, the verses in the title of this panel maybe creates a wall that should not be in the room. Peter Bakker commented on that before very beautifully. He said, we don't have the luxury to discuss it, right? And that's the bottom line of what I want to share is and instead of or. And in 2025, as we currently sit, we should only talk about and, like reduction and removal and much more, like conservation and adaptation. Now, and that's as a segue to finally come to answering the question. Yes, we started out by developing technology to remove CO2 from the air, store it in the ground. I'm engineer by training, believe in exponential power of technology. This is where we're coming from. And like clear measurability, long duration of storage. However, over time, we learned that the market, like the real customer need, is to buy portfolio of carbon removal credits, right? And we are we used to be one pillar of that. So we said, why, as a commercial enterprise, should we be sitting there and watching others serving this market, where we built up a huge sales force over time, a lot of trust in the market? So we, several years ago, started to jump into looking into afforestation credits, biochar, BECS, enhanced weathering, and today we offer portfolio. Now, very beautifully, not only is this a customer need, but it's also scientifically proven that portfolios of carbon removals are more economical, require less land, less energy, less water, instead of single solutions. Why? Because there's scaling limits to each of those solutions. So I think it's one of those instances where like customer need and science actually fit and work together. And this is why we are following this approach. Last comment, like if you take maybe two perceived extremes like trees or afforestation, reforestation, and machines, very beautifully, they are uncorrelated, right? And we know that from current financial markets. What you want to have is uncorrelated assets or items in your portfolio. And I think we should appreciate and acknowledge that those being uncorrelated can also be a super important aspect in order to scaling this whole industry, because there are risks assigned to that, and you want to avoid the correlation between the two.
That's great. Thanks so much for sharing that, Christoph. It sounds like an excellent combination when you think about portfolio construction that meets both the customer requirements, but also the intersection with science as well. And wanted to touch on sort of the point that Ben raised around integrity and quality. And so to you, Tommy, BeZero does carbon ratings over a multitude of projects, right? Can you maybe help us understand a little bit whether is there a ceiling for reduction projects, i.e. is there like a best rating that a reduction project can achieve? Conversely, is there a floor kind of for removals, like even the worst removals project will at least get this rating? Is that a myth that you'll be dispelling, or isn't it true? And whether you could also share kind of the split of well-rated projects, however you define the cutoff for well ratings within these respective categories.
Thanks. So I've been told not to make any jokes, so I will stick to the stats. Okay, so I had a look. We've rated about 510 projects, which you can look at on our website, bezero.com. Distribution of avoidance is AA to D. The distribution of removal is AAA to D. The drivers of those risks, which are in simple terms, additionality, carbon accounting, and permanence, there is a small trend, obviously a small bias for all of those risk factors to be slightly better when it comes to removals. Maybe it's tangibly, generally the absence of any other form of revenue is a really important signifier of additionality, and sometimes it's easier to prove, like in the case of direct air capture. Over-crediting or carbon accounting, generally you start with a baseline of 0 for removals, although actually if you think about an ecosystem, it should be actually not 0, but actually a negative, because they do sequester something. It's not cement. So that taken account of. And then on the permanence, well, obviously nature-based removals are subject to extreme reversal risks and some forms of nature-based removal. So we find, I think Ravi called it a heuristic. It is a heuristic in the market. not necessarily borne out by the data. So there is no cap nor floor in either of our research. And I think that's an important point from our perspective. And then I guess just the last thing I'd say is, I mean, again, he's not in the room, I don't think, but Ravi talked about Orwell. There's another book by Orwell from the date, which says, reality is in the human mind and nowhere else. Well, integrity is in standards and project level analysis, because they go hand in hand. And I think that the standards do a very good job of raising the bar and making sure that you basically are solving some of these inherent issues. But, performance is difficult. This is nature. You can't just turn it into a securitized asset. And even that goes wrong in 2007. So, I think that's what you're trying to achieve here. I think that the two things just generally show that. And maybe just to finish, the only thing wrong that my team could find with my colleague on the right's project, which is the only AAA on our platform, was a exceptionally 2-week debate in which we brought in tectonic scientists to discuss the future of Iceland's tectonic movements, and was it okay that the shortest time frame they could think of where there might be a tectonic event which might cause reversal in that particular type of direct air capture was 500 years, and was that therefore sufficient proof to get a AAA? So you go into very specific detail here, and that was the worst thing we could say about that project. But it's the only AAA we have given in the market post-issuance. So it just gives you a sense of the level of rigor you need to go to, and potentially, hopefully, dispels the myth that nature technology avoidance removal has a discernible trend because it's one or the other.
Right. No, thanks for sharing that. Actually, I want to double click a little bit into that because you talked about the spread of ratings. So it sounds like it's actually not that different between reductions and removals, because it's AA to D for reductions, AAA to D for removals. And are you therefore then seeing a correlation of pricing to the ratings? Because we've always talked about how to make the market scalable, to have the right credibility. Pricing needs to reflect the ratings. And actually at this point, I also want to already pick up one of the questions that's coming in from the audience. Thank you for your participation. Is a pricing gap between reduction and removal projects warranted, even if they've sort of earned similar levels of ratings? And oftentimes it's on the back of technology removals credits requiring higher cost and therefore requiring higher prices. Do you think that this pricing gap is warranted if both the reduction and removal credits projects in fact have the same rating?
Yeah, okay, so two quick points. You've obviously prepared this question. So here is one I made earlier. We do annually analysis of ratings versus price correlation. In 2021, when I happened to do it, it was R squared of 0, essentially. Maybe it was the rating, but that's for you to decide. Last year, we found it was a 40% price increase per ratings notch. And so, if price times quantity is the return, what you're trying to incentivize is to people to make more conservative, implementation, and they get more than rewarded via the uplift in price. And you are starting to see people reward a race to the top, and that is a really key market function of ratings. That is separate to the two different price curves, which I think actually Ben alludes to very well in all that work, which is nature needs an inflationary cost curve and technology needs a deflationary cost curve. And those two they're not necessarily, therefore, associated with the same point I was making about the price distribution. The eternal question we get asked, which is when you have a high duration, expensive CDR project given a BBB, and you have a high quality nature-based project given a AA, one's at $200 and one's at $20 or $30, well, for me that's comparative advantage. The efficiency should be you buy all of the stuff at 20 and then you just go up the cost curve, right? But that's for policymakers to decide, therefore, what's eligible in those markets. If they say both are eligible, you buy the cheap stuff and you move up the cost curve. But if it's ineligible, then obviously the nature just goes to waste. So that's kind of a picture of the pricing. Yes, a correlation, two different price cost curves, and then it comes down to probably eligibility in the market.
Ben, did you have a point of view as well? Because I think in the Oxford Principles, you also advocate for a development of innovative approaches, and one of the aspects is creating price incentives to support some of these high quality projects. What do you think about some of the pricing gap in sort of the reduction and removal projects? Do we need some innovative approaches to sort of bridge that gap as well?
Yeah, I mean, that's a great question. And I think Tommy's answer to this question was really good. I mean, the way I've been thinking about it, some of us have been thinking about it, is kind of looking at other examples of where policymakers have worked together with the private sector to create an investable and bankable price signal. And we all know that voluntary carbon market compliance market, you have a volatile price, you discount that down, that increases your cost of capital. Can we de-risk some of these cash flows? And I'm a big believer in advanced market commitments of different kinds, and think, some of the ideas that have been implemented in practice, like a small pilot in the UK, the Woodland Carbon Guarantee, which was essentially a put option for project developers, are very effective ways to create that bankable, investable cash flow for project developers. So you buy a put option from the government or from an entity that might be underwritten by the private sector or buyers, and if the strike price is below the market price, you exercise the option, and if the price is above that, you sell into the market, and the government or the buyers don't have a liability, and that's a very efficient way. And I think we've kind of been talking about these instruments for, I remember writing a paper about this in like 2009 with colleagues at Climate Change Capital, where I was working at the time. These things can be scaled very, very easily, I think, and it's one of the things that is, again, sort of quite disappointing about how we've approached this more from a policy perspective, domestically and internationally, that there hasn't been a consistent effort to kind of do that at scale and to work back from where we need to get to. And I think it's a sort of perhaps a bit easier to make this point with removals, but you can go, okay, well, this is the quantity of removals we're going to need roughly in 2050. Where is the pipeline to get there? And then let's use these advanced market commitments to build out the supply side and to get the pipeline scaled in the way that it needs to be.
Right, thanks, Ben. You mentioned a couple of times around sort of policy failure and how to get some of the policy standardization. Maybe we'll pick up on that from one of the questions subsequently. But in the time, in the meantime, I did want to flip it a little bit back to Will, and maybe it's hard for you to be a critic of your own project type, but as you think about a conservation project, what are some of the shortfalls or areas, inherent risks, higher risks of overcrediting that can arise? And actually, how do you actively manage that and mitigate the risk?
Well, I mean, firstly, I'd make the point that I think the real risk that we need to manage against or manage for is that we will lose these vast areas of natural systems that still exist, right? As I said before, the historic trend suggests that we will, if we're not careful. And I would put this scenario to everyone. If we decided to not invest in nature-based solutions in the reduction sense, does anyone in the room honestly believe that those forests, grasslands and wetlands are still going to be there in 10 years? I mean, I just don't. So we're caught up in this sort of debate. I take Ben's point, and I totally respect it. I'm not suggesting that we should be sort of dismissing removals by any sort of sense, but we run a real risk here if we're not careful, and I'd sort of argue in a little bit that the price signal here may be a little bit of a market failure, that we're not finding a way to adequately reward and support the conservation of these vast areas of forest, wetlands and grasslands that still exist. They're there, the carbon's there. And I can tell you from our point of view, every day I'm actively involved in about 4 large conservation initiatives across the region at the moment. And every day we're redoing the analysis to try and figure out how we can make it work financially, to make it more attractive for the landholder or the partner or the joint venture partner, whoever it might be, to invest in conservation rather than further degradation and destruction. Like, we need to radically sort of turn this around. So from my point of view, that's the real sort of risk we need to mitigate against. To your point though, I'm not suggesting that we sort of have an open slather sort of unregulated approach, just like whatever carbon project gets credited, whatever. Of course, we need really high standards, and I think the previous panel was sharing some great examples of how integrity has really come back into the market, and with a huge sort of emphasis on tightening up the standards. We're seeing the rating systems come in. So I think we're on the cusp of being able to be both confident in both types of credits, which is good, and we shouldn't be as worried about it as what the debates have suggested we should be. But really importantly, to not sort of lose sight of that huge opportunity we have in front of us to finally change the economic calculus around whether or not to protect a standing forest that's already there, because it will be lost. It will be lost. And then we'll scratch our heads going, oh, oh, maybe that little debate we had about the methodologies and whatever else wasn't really relevant because the broad trend was towards destruction and degradation.
Sure.
Yeah.
Yeah. I
Can
think
I
we'll
just
go on.
jump in? You did encourage
course.
us to jump in quickly. I mean, so obviously, we must all agree with what you just said, Will. But I do wonder whether anyone really believes that the voluntary carbon market is going to provide the amount of money that you're suggesting it does. Just, those problems are massive challenges, and just to, if somebody could Google the amount of money that Indonesia got from palm oil exports last year, I mean, it's obviously, it varies, and it's tens of billions of dollars, just Indonesia, just palm oil, and you compare that to the size of the carbon market. We've got to, clearly this is an important conversation, but to suggest, even imply, which I think you're kind of doing actually, that this emissions reduction, avoided emissions conversation in the carbon market in relation to standing forest in a place like Indonesia is really going to get us anywhere near to solving that particular problem, I think is wrong.
No, and I didn't, not suggesting that it's the only part of the puzzle by any stretch, but I can tell you we are dealing with, so we have with a philanthropic investment, supported a partner to acquire a forest concession, and when you run the numbers and you're looking at a shift towards sustainable logging practices versus unsustainable logging practices, the carbon price can make a material difference in that shift. And you go and talk to the neighbours and you say the same thing. Would you be willing to try shifting from an unsustainable practice towards a low impact, reduced impact logging methodology, but you don't have a carbon price to do it? The answer is no. So they do shift the investment decisions in a significant way. I'm not suggesting it's the silver bullet and solves everything, but to have that not on the table or to have a sort of a price penalty against it does change the economics for those decisions in the landscape.
Thanks, Will and Ben. And I think essentially we're touching on the point of sort of additionality of carbon finance to changing the baseline or the counterfactuals. So actually coming to you, Tommy, because you would have seen, say, AA rated conservation project. How did they what were the parameters that went into it that helped them to overcome these risks of overcrediting, of baseline additionality? Can you share some of the best practices as project developers or investors are thinking through around conservation projects?
Yeah, absolutely. Just to comment on Ben, I guess my argument would be it's a pricing problem. If your marginal cost of development of palm oil is less profitable than your marginal cost of preservation of the land, then it could be a channel, right? There's no reason why the mechanism itself is the problem. It's just that the cost of the marginal return. I'll give you one example just as I went to visit the Amazon to visit a project, and the average number of cattle, head per cattle per hectare in that part of the Amazon was 0.8. Are you telling me that is more profitable than preserving the standing forest? I find that totally bonkers, even if you then factor in the future of soil plantation. So that, I do think it's just a pricing problem. I don't necessarily think that the carbon market is the solution, but it's certainly a mechanism. In terms of best practice, additionality is, in very, very simple terms, would the activity have taken place otherwise? And so what you're really looking for is there being as little reason, and it's kind of a bit of a potentially a perverse discussion this, but is there no reason whatsoever that this activity would have taken place without the carbon finance? So a good example being there, that may be at odds with policy or philanthropy, right? So if there's policy money and there's philanthropic money going in to conserve this, is it truly additional? What you really want to see is the pitchforks at the side of the forest with the big kind of chainsaws going, we're going to chop this down, and there's nothing to protect it, and all forestry regulations have been wiped out, and Bolsonaro is back in charge, and all this sort of stuff, right? So that's an area in forests. But I think when it comes to technology practices, there are a lot of additional revenue streams, which may be the lion's share down to a small fraction, which will be the governing reason why that activity took place, which is why renewables is these days seen as much less additional, because I think it's 1% of revenue or less is a function of the carbon market. But then if you go into small island developing nations that import diesel and have diesel generators, they have a current account deficit and they're basically polluting with diesel. It's super additional in those countries, right? Because you really want to get the mini grids going. Baseline is about the counterfactual. If you like economics, every counterfactual can be proven or disproven, right? It doesn't really make sense. It's just a forecast. What people were doing historically was not necessarily bad science, is that they were picking a point in time and then not checking it again for 10 years. So you're forecasting the impact on an ecosystem and using large gaps in time before you then recheck what that would be. And forecasting error alone, even if you think that everyone was doing best practice, is pretty large, right? That's a pretty hard thing to do. And then on permanence, I think the challenge there is the biosphere, lithosphere stuff. I mean, once you get above about 50, 60 years, for us, permanence is a legal question. It's a Lockean problem of the property rights and what happens there, because otherwise, permanence is philosophy, right? Like, we're not going to be here in 5,000 years to know if the oil well is reversed. So, you know, it's good, but, you know, what we really, and then also if the biosphere is degrading, isn't that still really helpful if you're restoring the biosphere, and isn't that permanent as long as you don't change the land use? So, like, that's some examples, and bad practice, just to give you, sorry, one more digression. So some of the stuff that can be bad practice is overuse of technology. It's over-modeling environments. It's trying to use too much stuff, which basically tries to use very sophisticated Markov models to pixelate the impact of the forestry trend, but it has got no reality, basis in reality. That's an example there of a C-rated deforestation project. And by contrast, on additionality, just, you know, dynamic baselines, resetting, constantly readjusting, trying to have more real time. And that trend, you mentioned ICBCM, you mentioned ratings, you mentioned the quality of methodologies. Technology is wildly different than it was 10, 15 years ago. And our ability to model and monitor this stuff has revolutionized. So I think actually, if I was honest, anyway, to your point, it's the demand that's the problem. The mandating of demand, it's not the supply. The supply's got better and better and will always be a bit tricky. Anyway, that's a flavor of some of the stuff that goes, a variation within the implementation.
Right, thanks for helping us to unpack that. And actually just maybe turning the time also to Christoph a little bit to talk about removals projects. And the perception is often yes, better durability, longer permanence, although, you know, Tommy well articulated that permanence is oftentimes just linked to how long you're able to tie in the commitments to the project. So from a removals project's perspective, where do you see are the associated risks, and how have you looked to mitigate some of those in your design of the projects?
Yeah. Well, what I'm saying, or to answer the question, is applies to 2025 and could be very much different already in 2 years from now, because the market is developing super dynamically. The biggest risk, and that's what others have said before, is a lack of supply. That the biggest risk for a removal project at the moment is that it's not happening because there's a lack of supply. I'm oversimplifying by saying that generally removal projects have the same business model. They need upfront investment in order to get it running. Either you need land, you need machinery, you need energy. And the first question an investor will ask you is, do you have your order book complete over a 12-year horizon in order to guarantee the cash flows to get the money back? And to put maybe some figures on that, we're currently developing a project in the United States where the order book that investors are looking at is $2 billion, right? And the global voluntary carbon market, which is the only market that we can sell into in the absence of regulation, is $2 billion per annum. And that's just one project for one company, right? And that maybe gives you a bit of a understanding of like how thin the demand currently looks for this removal space. Now, how do we mitigate it is to work on regulation. But again, like getting up demand, that's the holy grail for this whole industry. So if I had the solution and the mitigation in capital letters, this problem would be solved. I don't have it. But yeah, working on all fronts, applauding. Before it was said that what SBTI did is a bit critical. We applaud it. We appreciate they at least put on paper permanent removals, have it in the current revision. Working on regulation, the EU is currently revisiting the EU ETS scheme, considering to include carbon removals into it. So working on all of those fronts. Now zooming into carbon removal projects, maybe more on the execution side, I can speak about our project in the US, currently developing a plant, capex beyond $1 billion, half of it in an award by the Department of Energy that was granted 2 years ago. Of course, we did a lot of policy analysis. Direct air capture in the US is a bipartisan topic, very strong bipartisan support for different reasons, supported by Republicans and Democrats. Did we assume in our scenarios what happened? Well, we had it, one column, it was a 5% case. But currently, as sitting here, I really don't know whether the project will happen or not because of political uncertainty. So I think a stable policy environment is super important, especially for those high capex long-term projects, and that's a major risk, which I'm afraid, very painfully observe right now. And how to mitigate that. Just in the other room this morning, I found a very beautiful discussion between third derivative and Breakthrough. And I think Breakthrough mentioned they have a portfolio of, I don't get the numbers right, but something like 130 companies, mostly focused on innovation. And they might have overlooked the importance of project development and to bridge the gap between innovation and deployment and getting real project finance into the projects. And that's the mitigation for it. Like the mitigation for this, for what I mentioned before, the policy risks is geographical diversification and very sophisticated project development, very sophisticated partnership in other regions of the world. That's what we're doing right now. We just announced the partnership we're having in the Kingdom of Saudi Arabia. We have one in the UK, in Canada. So if we have fallouts, that we can bet on other geographies. And the same we do in the nature space. In nature, the risks are, of course, very different, maybe more climate risks, and in such, the answer is geographical diversification.
Great, thanks so much, Christoph. And I think the two themes that have consistently come up is demand and policy. So actually, I'm going to pick up on one of the audience questions around demand and pricing, which is quite interesting. Can we fix a floor price per ton for removal or reduction? And for better rated projects, can we then ascribe sort of 3 times or several more times credits? That way we establish a more systematic way of thinking about pricing. Tommy, views on that? Do you think that's helpful to have a floor price or not?
Yeah, it's a policy tool. It's not a market mechanism. I mean, there's a floor price in electricity and to make sure that the lights stay on. So it depends on what model you want to use. Yeah, I think so. There is one vision of a carbon market, which is a power market. All credits are equal. Credits are kilowatt hours. You have eligible supply. That eligible supply clears where your price meets your marginal price meets your demand. That excludes nature. There's no way you can have nature in that topic. So I think hopefully we can agree that that is suboptimal as an outcome. But that is where a lot of people are going with some of their arguments. In terms of what we do, diversification is a great point that Christoph made very eloquently. If you want to take it much further, we think of rating as an actual discount. Rating actually applies. So AAA is basically 99% chance of delivery. A D is basically 1 in 10,000 chance. So you can actually create a risk-adjusted ton by blending a portfolio, which isn't as simple as just over-purchasing, and you actually look at the covariance of the risks across that. I'm not entirely sure the world is really that into risk-adjusted tons, although we are trying to do that with some people in the room. But that just gives you a sense of where the financialization of this market is going if you can settle down the underlying parameters. And in that world, you can be over-purchasing so that you aspire to an atmospheric return, as opposed to talking about buying credits. You look to buy a return of those credits, a bit like a pension fund. That would be very cool. I think that's where some of the people are going, lower marginal costs, better outcomes. But I just don't think that's what people want right now. But yeah, floor pricing would be great, but it just depends if you allow nature in.
Ben, from a policy tool perspective, because you talked about policy failure, maybe more need for more policy intervention, do you think that fixing those floor prices would be helpful or actually detrimental?
Well, I mean, with the example I gave with the MC, I mean, that's a way of creating a floor price, and of course you can design that to target specific removals or reductions in specific geographies if you wanted to. I mean, there's all sorts of ways of doing that. I mean, I think the point that Tommy was also making, just to build on, I mean, I think, the way this conversation is framed and other conversations are framed are very much around, a fungible instrument, a tradable instrument, a market in that sense. And I've always thought that, that isn't necessarily the way we should think about these things, and the methodologies that are used, they're essentially ways of creating effective results-based payment mechanisms, results-based contracts. And I think we should be, particularly when we talk about nature, but also these other things, that's how we should be thinking about this. And actually most of the investment, I think, that will be deployed will be more under the kind of results-based contract model rather than using kind of fungible, tradable instruments. And that might be an unpopular thing to say in this audience, I don't know, but you can then see it being applied in many more ways throughout the economy as well, thinking about it in that way.
Good. And also I think we talked about kind of activating more policy decisions with some of the standard setters. Again, one of the questions here around how can we reinforce the support for reductions and removals with standard setters such as the SBTi? which obviously a lot of corporates rely on for their guidance on what kind of credits to purchase. So Will, maybe question to both Will and Christoph, as you think about kind of the policy engagements, how do we reinforce this support with the standard setters?
Maybe Christoph, would you like to go first?
Yeah, well, I mentioned before, like currently, I take whatever we can take because currently the space for removals is void. There's nothing, there's really nothing we can hold on. So if, again, for us at Climeworks, we were extremely happy when the SBTI only mentioned that they're considering, see where we are, right? Like really early stage, permanent removals as of 2030. And the range is between recommendation to requirement, right? Obviously, that's very different, but it will trigger something. So on the voluntary side, we are really hopeful that the next revision of the SBTI will land the permanent removals as a requirement by 2030, and I hope everyone in the room will buy into that. I doubt everyone will, but just to put on one stick. And on the more regulated compliance side, for us, the EU ETS can be really big. Like if carbon dioxide removals were integrated in the EU ETS and some novel financing mechanisms like the eighth world wonder of financial compounding. Like I recently saw a paper published by the German KfW and the Potsdam Institute of Climate where they talked about a cleanup certificate. So companies could choose between like paying for an emission reduction today, or a cleanup certificate in the future, and there could be compounding in the meantime, and such carbon removals in the future can be economical. I think there can be very creative things, very creative financial instruments that would be an absolute game changer for this industry.
And Will?
Oh, just quickly, I think it's a sort of a little bit of gratitude for the fact that when the market has taken a big hit, and we've seen a lot of criticism, and often from environmental NGOs, ironically, the fact that academics, policymakers, governments, industry players rolled up their sleeves and responded to the critique and started to tighten up standards or address policies and whatever else, from my point of view, is hugely important. And that's what I meant before when I said I feel like we are on the cusp of hopefully getting to a point where there is that less of these sorts of debates perhaps, but also more broadly in the market, less concern around the issue of integrity, so that we can get on with this. And yeah, totally, I think Ben's idea of results-based payment as well as a new innovation, I think, well, not a new innovation, but an opportunity or an area for further growth in investment as well. And we are seeing foundations and trusts start to sort of focus a little bit more in that space as well, which is encouraging. So.
Great. Thanks very much, Will. And I think, as the panelists have said multiple times during the panel, since the beginning, the debate of reductions versus removals is a red herring, it's a distraction. So let's focus on quality, and thoughtful project design and implementation is what drives quality. Already today, we have industry markers like the ICVCM, the ratings tools that use scientific approaches to help us assess quality at both the methodology as well as the project level. So any prolonged debate on reductions versus removals, and either or approach is going to be just dangerous, unconstructive, unproductive to climate action. So combating climate change, we need a combination of these tools, and let's start today. So with that, thank you for your active participation on Slido today, and thank you to my fellow panelists for a very engaging discussion.